everyone, it's Michael here from Michael Howard Finance. I'm bringing this video to you today, just a little bit of fun, just to answer some questions that I think that if you're out there looking for a reason to use a mortgage broker versus using your bank directly, I think these are some really good questions that'll answer some things that you know would be important in that scenario. So I'm going to interview someone today, and for that reason, I would like to introduce Michael. G'day Michael, welcome. Perhaps you'd like to start by introducing yourself. Sure. Hi, I'm Michael. I'm from Michael Howard Finance. I'm a finance and mortgage broker. Excellent. Now, why should I use a finance and mortgage broker rather than going straight to the bank? Okay, so that's a really good question. There's probably several reasons that I would consider that you use a mortgage broker rather than go straight to your lender. The first is that I'll sit down and through our conversation together find out all about you and what you want to achieve, both immediately and in the future. So looking at what are your dreams, what do you want to, the things you want to do, and then from that I can then look at my panel of lenders. So there are several lenders that we do look after and have on the panel. We then put that scenario to many lenders, and I think that's probably one of the best reasons why you should come and use a mortgage broker, is because it's not just that one lender. Like if you walk into into your main bank, they're only going to offer you their product. So whether that's the right product for you and the best one for your situation, you don't know. They're not going to tell you that, whereas I can evaluate that and definitely let you know. Cool. So how then do you decide which loan is best suited to my personal situation? So that then comes down to the in-depth interview process that we go through. I'm all about this being our long-term ongoing relationship. So I'll sit down and go through everything with you. I basically take all of your details as they are today, so that I know everything about you. Past work history, addresses, all of those sorts of things. They're just the basics that we need to sort of build a profile about you. And then it's looking at what's your current financial position, the incomes, your expenses, what liabilities you've got, all of those sorts of things. What's your asset pool like? What have you already done up to this point? And how that's going to affect things. So essentially, I take all of that information, and that allows me to build a picture about you, and then look to put you towards the appropriate product for what you want to achieve. Excellent. So what commissions do you get paid for writing my loan? Okay, so that's actually, I'm finding something that most people don't know how mortgage brokers get paid. It's one of the things that even if they have used a mortgage broker, some people sort of say they don't quite understand how that works. So as it stands, we get paid by the lender that you're introduced to. Now, and it's not the same rate across the board. It's very similar. The average is probably about 0.65% plus GST of the loan amount. So, as an example, if we write a $300,000 loan, the commission that I get paid is based on that loan limit. So 300,000 times 0.65% gives you that upfront commission. But then the other bit that most people don't actually know about and understand is the trailing commission. Now, we get paid a trailing commission based on the loan amount every month that the loan remains active and not in arrears. So if you go into arrears, then I stop getting paid that. But essentially what a trail commission is actually, and this was changed many years ago, it was actually considered to be a deferred upfront. So originally the upfront commissions, before I got into the industry, so well over 6 years ago now, the smaller lenders, to be competitive, all came together. The industry themselves, the lending industry, came together and decided to make it a fairer scenario, is that they would pay mortgage brokers a deferred upfront. So the initial upfront commission amount was lowered and then paid over the rest of the life of the loan. So that trailing commission stays active whilst the loan that you have, that I've written for you, stays active. Excellent, that's really interesting. Do you offer a range of different lenders? Yeah, we do. I aggregate through a company called Connective. They are basically my conduit for all my compliance needs, but also they have the panel of lenders that I get access to as a finance and mortgage broker. We've got up to, I reckon about 40 different lenders on that panel, and I'm directly accredited with about 25 or 26 of those at last count. So I've got a huge, number of options available to me, and in saying that, because I don't have the full panel available to me, if there's something that we do need and I can't find it within that group that I am directly accredited with, then we might have some other options in there. But not every lender does everything that we need. So I've sort of built my panel up based on who I've been seeing, the clients and the particular things that they need help with. But at any one time, I suppose in the last, say 12 months, calendar year, I've used, I reckon I would have used between 6 and 8 different lenders over that time period. So it's a really fluid environment. The lenders chop and change. It's really competitive. That to me shows that it's a competitive market, and that lenders are always chopping and changing to try to get some more market share. Doing different things. They might decrease their rates here. They might offer some fee changes or rebates over here. So it just depends on what the clients need and what's available at the time. And I assess my panel at that point by putting in your details and let the software do the work for me, which is the beauty of what a broker does. Cool. So what impact would my credit card limits have on my borrowing capacity? Okay, cool. So that's a really good question. Credit card limits. Now, this is one of the first things that I sort of really took notice of when I got into the industry. Credit card limits, in a real basic sense, for every $5,000 of credit that you have, it can affect your borrowing capacity by approximately $25,000. So if you've got a $5,000 credit card, when I put in all of your details, and if we're not doing anything with that credit card, you're keeping that $5,000 limit credit card, the balance is irrelevant because you've got access to $5,000 of credit, so we assess you as having a $5,000 debt, even if you clear it every month. That's another point in that I should probably say, is that there are a small number of lenders that might overlook the credit card limit if we can show active clearing of the credit card every month. But in general, we work on the credit limit. So if you've got a $5,000 credit card and we're not getting rid of it, it will affect your total borrowing capacity by approximately $25,000. It's slightly different between lenders. Everyone has slightly different calculations, but thereabouts.
Okay. So do you think then my spending habits has anything to do with how the lender will look at me?
Yeah, so that's a really big thing actually, and something that I'm actually quite passionate about within the industry. There's a lot of talk between my colleagues and industry professionals about how the living expenses, so your general everyday living expenses and expenditure, looks to a lender. I go into a reasonable amount of detail with you about that. Basically, yes, it can affect you how you're looked at by a lender. The one thing that I said, so I'll never sit there and tell you that you need to stop spending your money. It's your money. I rarely see people spending more than they have, but I regularly see people spending everything that they have. So it's probably just understanding that, and the way that the lenders are probably looking at it more so today, whilst there are a lot of categories that we look at, you've got your rates and utilities, emergency services, all those sorts of things in that sort of particular, everyone has electricity bills and gas bills and water bills, all those sorts of things. And you've got insurances, groceries, everyone buys groceries, however you buy those, there's lots of different options in that space as well. But where the lines kind of change these days is where we've gone from those things being the required expenses, things to keep your roof over your head, the things that you need to do and to maintain your health and well-being, you need to eat and drink and all those sorts of things. The line's sort of been blurred somewhat now with all of the what's used to be considered discretionary spend. Now now it's probably more so looked at because we tap everything. Everyone, uses their credit, their key cards and bank cards and whatever, and just taps everything. Everything's recorded. There's always a digital footprint or those sorts of things, unless you're still out there using cash for some things. Though in saying that, you're still withdrawing money, so you're assumed to have spent that money if it's come out of your account. But it's that line now where discretionary spend, where we could, in the past, have gone, well, okay, well, you don't have to spend that. If we take out a loan for, it's $1,000 a month more for this loan than what I was spending on my rent, you'll just cut back on some of the things that you're spending as discretionary, eating out or any entertainment things you might do, or sports memberships or gym memberships, or one of the big things these days is that we're very much a subscription-based society now. So everyone, I would be surprised if I saw someone come to me and they didn't have a Foxtel or a Spotify or an Apple whatever, like some form of subscription. We've got our internet, that's a monthly cost, your mobile phones, all of those sorts of things. Some not so much discretionary. Today it would be considered having internet or having a mobile phone as a necessary item in today's lifestyle. The other things that would be considered discretionary would be those Spotifys and Foxtels and those sorts of things. And once upon a time, we could say, well, we'll just get rid of those. In reality, most people won't do that. So we need to factor that in because it is seen as regular and ongoing. And that's what I say now is that, okay, if it looks over, say, a 6-month period as though that payment is regular and ongoing, then we need to factor it in. So really it becomes a pattern of behaviour. Over a 6-month period, it might be that I'll say, right, and it's not often, but sometimes it does happen, for what you want to achieve, you might be quite literally spending a bit too much, so you need to maybe change your scenario in your spending habits for that 6-month period, and because that then becomes more of a habit over that period of time, that we can show that you've got X amount of dollars that you can afford to spend on that new lending. Otherwise, realistically, you shouldn't be borrowing that extra amount of money because that's your spending habits. So that's how I so in a nutshell, yes, I think your expenses can affect the way that you are looked at by lenders and how much you can borrow.
Okay, now what information do I need to provide you to obtain my finance?
Cool. So that chops and changes. It depends on your scenario. You could be simply purchasing a home. You could be refinancing your current mortgage that you're with another lender. You could be building a home. There's lots of different options, and each individual option, and even how you purchase that property, whether it's in your name and maybe your partner's name, or whether you buy it in a trust or under a company scenario. Different structures require different documents. So the list isn't necessarily defined as just a one-size-fits-all. It depends on your scenario specifically. But the basics are always going to be, I'm going to need up-to-date income. And if it's not shown on your income, pay slips and those sorts of things, that you earn commissions or bonuses or overtimes, those sorts of things. And it's not easy to see whether it's regularly being paid to you by way of your group certificate or your payment summary. Then we need maybe a letter from your employer just to highlight that you do get paid those items, and we can sometimes factor in some or all of that income. Expenses, we need to look at all of that. So we'll always do an expenses outlook, collect bank statements. There's software that we use these days that can help with that process, makes it a lot quicker. And that's a conversation I'll have with everyone. We have to do that. So we need to collect all of that information. That's 6 months worth of statements for all of that, statements and transaction history. What else would there be? Obviously, if it was a purchase, we'd need a contract of sale. From that, then we can obviously order the valuations and those sorts of things, so we can get that information and make sure that the lender's going to accept that property. Refinance scenarios, we need statements for the debts that we're paying out from the other financial institution, any debts that you might have, credit card statements. Some lenders, that chops and change, we'd always let you know. Generally, we'll always collect at least 3 months worth of transactions. I like to personally collect 6, just so that I understand again that living expense, you know, how you're spending your money essentially, because there's, you know, the last thing we want to do is on that is not miss disclosing a debt. You know, you might have a Go Mastercard. That's a really popular one that you've, you know, taken out at Harvey Norman, you know, years ago. You paid it off, but you never closed that account. That's a credit account, and if you don't tell me or disclose to me that you've still got that account open, there's a, you know, a $3,000 or a $4,000 credit card still sitting there, and that shows up on your credit file, and the lender comes back. Some lenders don't like that if we haven't told them up front that you've got that debt. Some may well actually just decline you straight away. So it's, for me, I need to know everything. That's the key, is I need to know everything, but I'll relay to the lenders only what they need. They don't need to know everything if it's not relevant to the application, but I need to know everything so that we don't miss anything. But it's those basic things. We need the statements to show debts. We need income to show income, so that I can do those things, and then the living expenses overarching on that, so that we can factor that in as well, so that we understand what you're spending. And that's the basics. Beyond that, then there'd be other things, and that would come out depending on the situation that you're in. Excellent. Now that's some really good information. Thank you very much for all of that, Michael. I appreciate your time. So thank you very much. I hope you get something out of the video today. I look forward to bringing these sorts of videos to you over the coming weeks and months, just as I interview a few more people, and hopefully you'll get something out of them. Thank you very much. Enjoy.